Welcome to the Deep Dive. So if you were watching the markets at all this past week, leading up to October 19th, you might be feeling a bit confused right now.
Yeah, cognitive dissonance is probably the right word for it. I mean, look at the numbers. The S&P 500 shot up 1.7%. NASDAQ gained 2.0%. That's a pretty strong week.
Right. A really strong rebound. But, and this is the confusing part, the U.S. government shutdown is still grinding on, isn't it?
It is.
And we had another scare with the regional banks flaring up again. You'd think that would mean, more volatility, maybe a down week, but nope.
Exactly. And that contradiction, that's what we really need to unpack today. That's our mission for this deep dive. We need to look under the hood of that rally.
See what drove it.
Yeah, figure out what two pillars of optimism apparently were strong enough to push things higher, and then, maybe more importantly, look at those risks that are still lurking, the ones the market seems determined to ignore right now.
Okay, let's dig into those pillars then. It seems like it boils down to two big things. A surprisingly dovish signal from the Fed, and maybe some relief on the global stage.
That's pretty much it. Let's start with the geopolitical side, because that kind of set the stage. We heard comments from Treasury Secretary Bessent that really seemed to cool down those U.S.-China trade war fears.
Which pop up constantly.
Right. But this time, the tone from both Washington and Beijing felt, well, more conciliatory by the end of the week.
And it wasn't just talk, was it? They're actually trying to set up a face-to-face meeting in Malaysia.
That's the key, setting up that potential high-level meeting next week. It suggests, a real effort to de-escalate this time. And for investors who've been worried about more tariffs, that's a huge relief.
Okay, so that's one pillar, geopolitical relief. But you said the Fed was maybe the bigger driver.
Oh, absolutely. The real jet fuel for this rally came directly from Federal Reserve Chair Powell. Midweek, his tone shifted quite dramatically, very dovish.
More dovish than expected.
I think so. He didn't just reinforce the idea that we might see 2 more quarter-point rate cuts this year.
Which is already significant easing.
Exactly. But he also dropped this really crucial hint about quantitative tightening, QT, where they shrink the Fed's balance sheet.
What was the hint?
He basically suggested they might stop QT before the end of the year. And the reason he gave was to maintain ample reserves in the banking system.
Wait, hold on. If inflation is still a concern, why stop shrinking the balance sheet early? Isn't QT supposed to help fight inflation?
It is, and that's the critical thing you need to grasp here. By talking about ample reserves, Powell is signaling something important.
Okay, what?
He's signaling that right now, the Fed is prioritizing financial system stability, making sure there's enough liquidity, maybe oversticking rigidly to the inflation fight.
So stability trumps inflation fighting, at least for now.
It seems like they're willing to let up a bit on the deflationary pressure from QT to make sure the banking system's plumbing, stays stable. That feels like a pivot towards easing whatever the next inflation print says.
That context is really important, especially because we didn't get a ton of economic data this week, right? The shutdown messes that up.
Yeah, data was sparse. But we did get 2 reports that kind of complicate things again.
Oh, which ones?
Well, first, the October Empire Manufacturing Report. It actually surprised big time to the upside. Showed stronger output, but also worryingly rising prices.
Rising prices. That doesn't sound like something the Fed wants to see if they're pivoting dovish.
No, it doesn't. But then the Fed's own Beige Book, which is more like anecdotal evidence from businesses.
Right, the qualitative stuff.
Yeah, that painted a different picture. It talked about muted economic growth and modest pricing pressures.
So manufacturing data says prices are rising, but the Fed's own survey suggests things are slowing down and prices are tame. How does the market square that?
It seems like selective hearing, honestly, driven by hope. Investors grabbed onto the muted growth story from the Beige Book because, well, it justifies the Fed cutting rates.
Well, okay. They focus on the part that fits the narrative they want. The Fed's easing because growth is slowing, not because they're ignoring inflation signals from manufacturing.
Pretty much. And you saw the immediate impact in assets. The 10-year Treasury yield, it dipped below 4% for the first time since March. That reflects those rate cut expectations.
And oil prices slid too, right? WTI below $60.
Yep, WTI crude below $60 a barrel. Mostly on oversupply worries, but that also helps the inflation picture, takes some pressure off. It felt like a global risk-on moment, even in Europe.
Oh yeah, the French PM survived those confidence votes.
He did. Le Cornu got through them, which calmed European markets down a bit. Less political noise over there.
Okay, so that's the macro picture. Fed relief, trade relief, lower yields, lower oil. But let's shift to the corporate side. Because you mentioned the growth driver was really specific this week.
Yeah, absolutely. While the Fed kind of enabled the rally, the real engine, the thing pushing growth stocks,
Yeah.
was this huge focus on AI. Just a massive ramp up in news and optimism there.
And it really contrasted with weakness elsewhere, didn't it?
Stark contrast. And the standout story, the one that really seemed to lift the whole tech sector, was what some are calling the Oracle effect.
Oracle, what happened there?
At their investor event, Oracle just blew expectations away. They dramatically raised their long-term targets for both revenue and profit margins. That's a powerful signal for tech growth.
And it wasn't just vague promises, was it?
No, and this is key. They gave a very concrete detail about their AI plans. Oracle intends to deploy 50,000 AMD AI chips in their fiscal year 2026.
50,000 from AMD, that's a lot.
That's a massive number.
Yeah.
And coming from Oracle, a legacy giant that powers so many businesses.
Right, it's not just a startup saying this.
Exactly. It signals that enterprise AI adoption isn't just hype anymore, it's becoming core infrastructure. And that specific AMD number, it helped keep AMD's stock near its 52-week high. Shows how tight that chip and cloud race is.
And it's not just Oracle. OpenAI seems to be spreading its wings, too.
Yeah, the whole ecosystem is growing fast. OpenAI announced new partners, big ones like Broadcom, the chip designer, and Walmart integrating their tools.
Walmart, wow. So AI really is moving into, well, everywhere.
Seems like it. Of course, you also had OpenAI CEO Sam Altman talking about this almost unbelievable $1 trillion AI infrastructure plan.
$1 trillion.
Yeah, huge ambition. Though that news came alongside a bit of controversy, too. Reports about OpenAI maybe allowing more adult content through ChatGPT. So, it's explosive growth, but sometimes messy.
Okay, so AI is booming, driving tech stocks higher. But what about other future industries, like EVs?
Yeah. That's the other side of the coin. The EV sector seems to be hitting a pretty rough patch, a real reality check.
What happened there?
General Motors announced they're taking a big hit, like $1.6 billion in charges related to restructuring their EV plans.
Why?
Demand. Consumer demand for EVs is cooling off quite a bit, especially now that some of those big U.S. rebates have expired. Makes the cars less affordable.
So even a hyped sectors aren't immune to higher interest rates and consumers tightening their belts.
Not at all. It shows that the cost of money and, limits on discretionary spending are really starting to bite, even in areas we thought were guaranteed growth stories.
Okay, so we've got the AI boom on one hand, EV slowdown on the other. Let's circle back to those jitters you mentioned earlier. We had the Fed and trade optimism, but underneath problems, particularly in finance.
Definitely. There was this really worrying split in the banking sector this week. The big money center banks, your JP Morgans, your Citigroups, they actually posted pretty strong results.
Why did they do well?
Mostly because the yield curve steepened. Remember we talked about the 10-year yield moving up relative to short-term rates?
Right, the gap widened.
Exactly. When long-term rates are much higher than short-term deposit rates, these big diversified banks make good money on that difference, the net interest margin. Their lending businesses benefited.
Hey. That wasn't the story for all banks, was it?
Not at all. Those regional bank fears, the ones that hit us back in the spring, they came roaring back.
Wow.
We saw some really disappointing news on loan losses from a couple of key regional players. Western Alliance and Zions were mentioned specifically. They had to set aside more money than expected for bad loans.
Uh-oh. And that immediately sparks contagion fears, doesn't it?
Instantly. And those fears got a massive megaphone when JP Morgan's CEO, Jamie Dimon, came out with that warning.
The cockroaches comment.
Yeah. He publicly warned about finding cockroaches in the economy.
That's such a vivid, kind of unsettling metaphor. What's he really signaling there for people who aren't familiar?
He's basically saying where there's one problem you can see, there are probably many more hidden ones if you spot unexpected loan losses at a couple of banks.
There might be deeper systemic issues lurking just beneath the surface.
Exactly. He's pouring cold water on the idea that everything's fine just because the big banks had a decent quarter. He's saying the stress isn't over.
And the market felt that. I mean, indices were up, but did that comment resonate?
Oh, it did. You saw it in the VIX, the volatility index. It spiked sharply early in the week, hitting levels we hadn't seen since that Trump tariff announcement back in April.
Wow. So even while the S&P is climbing, the fear gauge is jumping.
Precisely. It's a clear sign that institutional investors, the big money, were getting nervous. Hedging their bets, basically. Deep-seated fear, despite the rally.
Which brings us back to that core question, right? If the main indices finish the week strong, What was the actual underlying feeling among investors?
Yeah, and the data here is really telling and kind of counterintuitive given the rally.
What did it show?
Well, look at the fear and greed index. It actually fell slightly from 29 down to 27, still firmly in fear territory.
So no shift towards greed despite the gains.
Yeah.
And what about hedging, like puts versus calls?
That's even more stark. The put-to-call ratio, which measures bearish bets versus bullish ones, stayed incredibly high. It was at 1.52.
1.52. That's really elevated, isn't it? Means lots of people buying puts, betting on a decline.
Hugely elevated. So what this tells you, the listener, is that despite the nice green numbers on the screen, the overall mood is still very much risk-off.
Defensive.
Extremely defensive. The rally we saw, it felt narrow. It was driven by those big AI names, Oracle and the like, and probably some technical short covering after Powell's dovish comments.
Not broad participation.
Not broad participation, not widespread conviction in a sustainable recovery. And that makes the market feel, well, pretty precarious right now.
Okay, so precarious is the word. Given this backdrop, AI strength versus systemic fear, dovish Fed versus cautious traders, what should we be watching closely next week, October 20th to the 24th?
The big focus has got to be on inflation and how the economy is actually doing in real time.
Yeah.
The absolute key release is Friday, U.S. CPI inflation.
Make or break for the Fed's dovish stance.
Could be. It will either validate their pivot or seriously challenge it. Also on Friday, we get the PMI reading services and manufacturing. Those are important real-time checks on activity and, crucially, pricing pressures.
And we also get consumer updates, right? Sentiment and inflation expectations.
Yeah, consumer sentiment and inflation expectations are also out Friday. Plus, on Thursday, existing home sales. That'll show us how much damage those high mortgage rates are doing to housing.
Okay, that's the economic data. What about politics or Fed speak?
Keep an eye on three things. One, any movement, any progress at all in the government shutdown talks. That could boost confidence.
Do.
The Trump tariff deadline is still out there. That's always a potential source of volatility.
And three, Fed speakers.
Yes. FOMC member Waller speaks on Tuesday. Markets will be hanging on his every word, listening for any more clues or confirmation about ending QT early.
Got it. And quickly, for people watching the charts, any key levels mentioned in the sources?
Yeah, a few technicals were noted. For the S&P 500 ETF, SPY, the next resistance level is seen around $673.64, with support down near $652.
What about Bitcoin?
Bitcoin seemed to be holding support around the 108K mark. The next big hurdle, resistance-wise, looks like 125K.
And the dollar, the DXY.
The dollar index, DXY, looks a bit oversold, according to the sources, but it might face resistance trying to get back above 120 cents. Part of that is due to global issues kind of propping up the dollar, things like Argentina's economy looking shaky and ongoing troubles in the EU.
Okay, so let's try to wrap this deep dive up. The main takeaway seems to be this intense tug-of-war in the market.
Exactly. You've got this powerful, almost futuristic growth story driven by AI, Oracle, OpenAI, the whole ecosystem that's pulling things up.
But on the other side, you have these very real, very immediate macro stresses. The shutdown, hints of inflation still bubbling, and the fragility in the regional banks still weighing things down.
Yeah, and the Fed basically stepped in this week, threw the market a lifeline with those dovish signals, and gave the green light for a rally.
But the underlying fear, the defensive positioning, it's still palpable, isn't it?
Absolutely. Which leads us to the final thought we want to leave you with.
Okay, let's hear it.
Given everything we discussed, Powell signaling more cuts, maybe ending QT soon, do you think this is really it? Is this the sustainable pivot towards easing we've been waiting for? Or are those lingering inflation risks, like the rising prices in that Empire manufacturing report, going to be enough to force the Fed to tap the brakes again, maybe pause things before the year is out? Something to chew on.
Definitely something to think about. Keep watching those contradictions. We'll catch you next time.